Our Story Behind the Numbers project is on Airbnb. I'm Kaylin, and I'll be presenting with Ian and Michelle. Airbnb is an organization that fosters connections and belonging through its objective to connect hosts with guests. These guests are typically seeking a unique temporary living arrangement that reminds them of the comfort of home, while they also develop a connection to the surrounding community. The company makes its money through booking fees charged to both hosts and guests. Airbnb has a 6-part strategic plan. The first part involves investing in retaining existing hosts and discovering new hosts. Their goal is to increase the size of their host community to expand their business over time. They're also working to expand their range of services. One example more recently was the rollout of their long-term stays. Additionally, they're working to develop advanced support and training for hosts. This involves skills training for hosts, as well as suggestions on how they can provide a unique experience to guests. They're also working to focus on new product development based on the effects of the COVID-19 pandemic. An example of this goes back to the long-term stays. They noted that many guests were seeking longer stays than a few days or a week. So they had rolled out this new program where they're developing long-term stays with their hosts. Additionally, one of the company's many goals is to make Airbnb more accessible on a global scale. They're planning to expand in India, China, Latin America, and Southeast Asia. These areas are where they have a limited presence, so they're looking to emerge and develop in those areas. They're also working to redesign their platform and improve host and guest experiences. And they're trying to do this by increasing engagement among existing users while making their platform more accessible to new users, essentially potential hosts and guests. The competitive environment of Airbnb consists of their competition, bargaining power of buyers, bargaining power of suppliers, substitutes, and barriers to entry. In terms of their competition, their main competitors are short-term and long-term rental platforms. For example, Vrbo, Booking.com, and Home2Go, along with many other websites and platforms. In terms of buyers, in this case, their buyers are their guests. Airbnb guests have a variety of options in terms of booking platforms, and Airbnb has a limited number of available listings at a given time in a given location. Many guests prioritize safety and cleanliness when seeking a rental property, which forces hosts to recognize these values in order to secure bookings. In terms of suppliers, this would include Airbnb hosts. Airbnb hosts also have a variety of platforms that they could utilize to list their rental properties. The company has been able to retain many of their hosts on their superior host protections. This includes, for example, their host protection insurance. There's also many substitutes to Airbnb's business. These would include hotels, online travel agencies, travel search engine products, rental listing websites, and websites that offer travel experiences. And in terms of barriers to entry, there are significant barriers to entry, such as existing infrastructure, including hotels, strong host and guest relationships with rental companies like Airbnb or Vrbo or the others that I have mentioned, and brand recognition among companies.
Hi, my name is Ian Bollinger. I will be discussing the balance sheet and stockholders' equity for Airbnb. The assets are primarily made up of cash, securities, fund receivables, and property and equipment. It's important to note that Airbnb's short-term assets account for the majority of its total assets, and that includes $2.2 billion of funds receivable, equates to about 20% of its total assets as well. Due to the nature of this industry and how this business operates, It's common to see a large fund receivable and also a funds payable due to the fact that Airbnb will hold on to the funds of its hosts and guests from the bookings until check-in, until those stays are complete. At that time, then it will both disperse the funds as well to its host and to itself as cash. And keep in mind, many vacations are booked 1 to 2 years out for competitive pricing, availability, and so on. So you'll continue to see a large proportion of funds in those line items of the balance sheet in future years. Funds receivable also decreased 31% due to cancellations and slowdown that the pandemic caused, and that is comparable across the entire hospitality industry the past year of 2020. Even though sales were down in 2020 due to the pandemic, Airbnb had a significant cash pile of $5.5 billion at the end of 2020. That's an increase of $2 billion from 2019, and that's through various investor funding and an influx of cash due to a recent IPO at the end of 2020 in December. So this cash will help it survive an uncertain future and short-term debts, and will also help it invest in expanding and growing its business and network of hosts both within the United States and Europe, and expanding into Asia. Another notable change in 2020 was its intangible assets. Airbnb did lay off a decent number of employees and had some cutbacks, and you can see that reflected on the balance sheet with a 26% decrease in intangible assets. Airbnb's total liabilities of $7.6 billion are primarily made up of accrued expenses, funds payable to customers, and long-term debt. Borrowing money from investors and layoffs likely contributed to these numbers. For example, accounts payable decreased 47%, likely due to cancellations, so no more holding funds, and employee layoffs, which led to a decreased amount of salaries paid. Long-term debt of $1.8 billion. It includes money borrowed by the company through first and second lien loans, and that funding is likely going to go support long-term operations such as its growth into Asia, so product development and research and development. Stockholders' equity totaled $2.9 billion, and that's an extreme increase from the previous year, solely due to its IPO initial public offering at the end of 2020. So giant influx of cash. They didn't really get any time through the rest of the year to do anything with that cash, so it's all reported just there as cash on the balance sheet. But it will be a good source of financing in the future. Airbnb's primary financing through non-owners is normal for the company in its industry that wasn't publicly traded, but I expect it to then shift to a owner financing company now that it has an IPO and it gets that cash stockholders equity. Airbnb has a positive working capital of $3.8 billion, just under a 2-to-1 ratio. So it leaves it plenty of cash to deal with short-term debt and obligations. And then that great deal of cash also gives it solid liquidity. However, I wouldn't count on that in the future. Once it spends that cash on investing in itself and growing its business, the company still isn't making money and bringing cash in. So I wouldn't expect that positive working capital to stay at 3.8 or in that good ratio. Return on assets is disappointing due to the large decrease in sales. So coupled by credits, refunds, discounts that likely happened during the pandemic, and that led to an abysmal net loss of $4.6 billion. Asset turnover of 0.37 is in the range of hospitality industry average. However, unlike Marriott and Hilton that have to build on all this infrastructure, facilities, resorts, Airbnb does not have to do that. And in that way, I think Airbnb should hopefully have a better asset turnover ratio rate in the future because of that. They don't have that burden of costs that Marriott and Hilton and other resorts have. Both the quick and current ratios look good on paper and see an increase from 2019 to 2020. But again, as stated earlier, that's solely due to that influx of cash that's probably not going to be there on future balance sheets for many years to come until the company can remain profitable. But right now, the company has high liquidity, but I don't think it will last. It's important to note that the liabilities to equity ratio of 2.6 is higher than the industry norm of about 1.6. But again, Airbnb is all about rapid growth and expansion. It's getting all this cash and it's planning on doing big things in the future. It's just not going to happen right now. You're not going to see any returns right now. In addition to this, the market cap to book ratio is about 2.9. So that's a pretty high ratio. So people are willing to pay a lot of money and think the company has a lot of potential in the future. It's highly speculative that it might make investors money in the future. Here's an overview of a common size balance sheet for Airbnb from 2019 and 2020. As expected, you can see a large influx of cash and a comparable decrease in funds receivable and payable due to the decrease in bookings that Airbnb has. Also, you can see the employee layoffs are affected by the decrease in intangible assets. And overall, total assets have increased. You can see long-term liabilities have also increased due to the borrowed money. And then you can see they've started paying off some short-term liabilities with that cash that they've got on hand now. As a manager, most important thing for me right now is cash on hand and how can I use that effectively and efficiently for research development, product development, and growing the business and expanding it to new markets to find profitability. Airbnb offers Class A, B, C, and H stock with currently 600 million shares of common stock outstanding and $2 billion available with no dividends paid. I believe owner financing is readily available to the company due to that large interest from investors and stakeholders and its speculative growth. Its market cap of $88 billion compared to its $30 billion book value shows and is an example of how interested and speculative people are of this company and how much they think it can grow. Overall, I think the balance sheet is propped up by that influx of cash from financing the IPO. These financiers see the long-term potential of the company and are willing to finance that company's large research development and their growth by tapping into Asian markets, trying different products such as long-term stays and various things that they tried doing and implemented in response to COVID. I think it'll take many years for Airbnb to become profitable, but I do think I see the potential with both the financial backing and the revolutionary business model. I think the company will succeed.
In this next part of the presentation, we'll be going over the income statement as well as the common size income statements. To start, Airbnb encountered many logistical challenges with the COVID-19 pandemic. These included cancellations, guests' inability to travel domestically or internationally, and a significant decrease in bookings. Alternatively, as a result, the company noted that due to the challenges of the pandemic, guests were seeking listings for different purposes, and these purposes were not previously recognized, so the pandemic actually caused a different kind of guest. These guests were usually seeking to find an Airbnb to live closer to family, at least for the time being. Many guests were also looking to live nomadically or work remotely or to attend school remotely. As you can see from the income statement prepared, the product development expense comprises approximately 45% of operating expenses. During the last year, Airbnb was forced to adjust and reconfigure their product and service offerings to accommodate a changing market based on the pandemic. This expense has been integral to the company's future strategic plan to enhance guests and host experience, to retain and attract hosts and guests, which is very unique to the hospitality industry. A point of significance to a manager would be the loss from operations. As you can see, the loss from operations has significantly deteriorated since 2019 and 2018. This would be a point of concern for management because it would allow them to reevaluate operations expenses and attempt to focus on improving income from operations. The loss from operations relates to Airbnb's research and development and product development over the past year due to the pandemic. Also, you can tell that from the operations and support expense line that there was a significant expense, which comprised of approximately 14% of operating expenses. This was due to the fact that there was a significant increase in cancellations and community support fees related to guest stays, and cancellations which were managed by a third party. So because they were managed by a third party, there were fees associated with that. Additionally, another significant expense was sales and marketing, which was attributed to the company's new marketing campaign, which was released in early 2021. They also had significant restructuring charges that they had not previously had in 2018 or 2019. This was associated with global workforce reduction, which occurred in May of 2020. As Ian mentioned previously, Airbnb underwent a significant amount of layoffs, and this was as a result of the pandemic, as well as their ability to restructure. These restructuring costs also included lease impairments and costs associated with amendments and terminations of contracts, including commercial agreements with service providers. In the next slide, you'll be able to see the common size income statements, and just going back to the operations and support expense. You can see here the comparison from 2018, 2019, and 2020. Additionally, Airbnb generates revenue through service fees associated with bookings charged to hosts and guests. These service fees are the largest source of revenue earned by the company, which have not dramatically changed over time, but were somewhat affected by the pandemic as a result of the cancellations and rescheduling from guests. So the company reports cost of revenue or cost of sales. These costs are primarily payment of processing charges, including merchant fees and chargebacks. Also costs associated with third-party data centers used to host the company's platform, and also these costs relate to revenue because they are the costs that enable Airbnb to conduct business and serve as an intermediary between guests and hosts to book spaces and experiences worldwide. Interest was a significant expense for Airbnb in 2020. Because of the company's long-lived assets and the debt associated with long-term assets, there was $161.7 million increase in interest expense from 2019 to 2020 due to Airbnb owing interest on their long-term loans. They did not make as much money on their interest income because interest rates were lower during the pandemic. So all in all, they had to pay more in interest than what they made on their long-term assets. Their stock prices were also affected in 2020. Their stock prices decreased over the course of the year. From 2018 to 2019, the shares only decreased by $2.52. And then from 2019 to 2020, the stock prices decreased by $13.62%. And this shows that the pandemic had a large impact on Airbnb's stock price. The profit margin for 2020 was negative 135.72%. The company was significantly less profitable compared to prior years, which was mainly due to the pandemic, but also guests were extremely limited in terms of traveling, so they had limited number of bookings as well. Additionally, their ROE, return on equity, was negative 4.38%. The calculated ROE is to be expected based on the reported net loss for the year. Other competing companies in the hospitality industry also suffered similar losses, if not more. And just some strengths and weaknesses For Airbnb going forward, their weakness was the ability to increase income from operations, which was a significant loss on the income statement. Their strengths are their continued commitment to invest in their strategic plan, specifically product development and research development, which is their main goal is to engage hosts and guests and also retain hosts and guests. Their ability to develop new strategies to emerge into geographical locations that have a limited presence currently is also a strength for them, with their plan to expand into these new markets. They also have limited product, plant, and equipment, which means that they have less risk and less expenses associated with maintaining infrastructure as compared to standard hotels and other businesses within the hospitality industry.
Next, we are going to talk about the cash flow statement for Airbnb. And this statement told us three major things about Airbnb. And it was that Airbnb did not have enough inflow of cash in their operating activities in 2018 and 2019 to foresee the negative effects of COVID-19, which increased the money they needed to spend on their operating activities. 2, Airbnb's cash flow from operations in comparison to income was negative, which shows that they did not earn any money in 2020 and could not pay their bills. And 3, Airbnb spent the most money on their operating activities, with money that they gained from their investing and financing activities. Within the cash flow statement, there are 3 major activities that tell us how Airbnb used their money. And these items are operating activities, which tell us what service Airbnb is providing, their investing activities, which tell us what Airbnb uses their money for, and 3, financing activities, which tell us how Airbnb gets their money. In 2020, Airbnb had reported a net loss of $4,584,716,000 and had an operating cash flow of negative $629,732,000. The operating cash flow adds back non-cash items such as depreciation and amortization, as well as stock-based compensation, which makes the operating cash flow larger or more positive than the net income, in Airbnb case, a net loss. The operating activities were considered to be a use of cash because Airbnb paid a portion of their assets off, which led to there being a cash outflow. This outflow of cash increased the amount the company spent on their operating activities. And because their net total operating costs were negative, Airbnb was unable to pay their bills. The investing activities are a source of cash, but were also used for cash as well. Airbnb used their cash by buying property and equipment as well as short-term stock. Airbnb used their investing activities as a source of cash by selling their short-term stock for a profit and having a portion of their short-term stock reach maturity, meaning whoever bought short-term stock in Airbnb had to pay back the full amount, usually with interest, back to Airbnb. Airbnb, as I stated, also purchased new property in 2020. The total that Airbnb spent in 2020 on these items were $37,371,000 compared to the $90,624,000 and $125,452,000 that they spent in both 2018 and 2019 respectively. So they almost cut down 2/3 on their property and equipment expenses. So the financing activities, which is the final group of activities, were used as a source of cash because Airbnb used common stock and took on more long-term debt because the operating activities and net cash flow was negative for the year. The investing activities cash flow was positive for the year. Airbnb used their financing activities towards paying off some of the debt that they acquired within their operating activities. Airbnb issued $3,650,870,000 of new stock in 2020 and they paid back their taxes and also their customers. They also took $1,928,880,000 in debt in the year 2020. They used their new debt to also pay off their short-term liabilities and their customers. Because they had negative retained earnings in 2020, as seen on the balance sheet, Airbnb did not pay any dividends to their shareholders. Based on their cash flow statements, Airbnb's weakness is that it is subject to people traveling and their vacations. So when an event such as COVID happens, the company as a whole takes a hit financially. Though they were eventually able to adapt to the changes they faced, such as the addition of long-term stays, Airbnb, like many other companies, was affected greatly by the pandemic. Airbnb, however, was able to take on some long-term debt, which shows that even when they had a down year, they were still a viable company to their financiers. Another strength that Airbnb has is the ability to make more income in future years without having a lot of money in assets, meaning they do not own the homes that they advertise to rent, making it less of a risk. Overall, I think Airbnb will become a successful company due to them having a much lower rate than hotels and minimal competition. As you see on the screen now, Airbnb had a net loss in their operating activities in 2020, with a large portion coming from their unearned fees, which decreased due to booking. Airbnb used the money earned from their financing activities toward paying off the debt that they saw in their operating activities. And though COVID-19 caused a negative impact on their operating activities, they were able to maintain a long-term loan. And that is all